Above the day-to-day left-right politics is qualitative listening. Hello, America. I'm Camille Chandler, and this is Qualitative Listening. Today, we're going to talk about how the bond markets reacted to the Iran situation and possible reaction to Iran's reaction. All right, let's start with the bond market's reaction. The 3-month is at 4.27%. The 6-month is at 4.26%. The 2-year is at 3.85%. The 5-year is at 3.9%. The popular 10-year is at 4.34%. And the 30-year is at 4.87%. So the yield curve is inverted to flat in the short end and steepening in longer maturities. President Trump launched a strike on Iran on Saturday, and there was speculation he did this on Saturday specifically because the markets were closed. But how ironic is it that on Monday, when the markets opened back up, Iran attacks a U.S. military base, so we see the bond market's reaction in real time. Another topic I'm going to touch on is Iran is threatening to attack U.S. supply chains. The talk is that this will affect oil prices, but will most likely be it because Donald Trump withdrew from the Iran deal in the first administration. A war with Iran, especially with U.S. or Israeli involvement, would almost certainly spike oil prices, and here's why and how it could play out. Number one, Iran's strategic role in oil markets. OPEC heavyweight, Iran is among the top 10 oil producers globally. Roughly 20% of the world's oil passes through this narrow waterway. Iran has threatened to block it in past conflicts. Even the threat of disruption raises panic in oil future markets. Number two, immediate effects on oil prices. Price spike. Analysts predict Brent crude could jump $10 to $30 per barrel or more if war breaks out, possibly pushing prices well above $100/BBL, depending on how severe and prolonged the conflict is. Volatility. Daily price swings could be extreme as traders react to missile strikes, sanctions, and troop movements. Number three, global ripple effects. Inflation pressure. Higher oil equals higher gas, transportation, and food prices worldwide. Economic slowdown could prompt central banks to delay rate cuts or even tighten again if inflation flares back up. Emerging markets. Most vulnerable, rising energy costs hurts growth and widen trade deficits. Number four, market counterweight. U.S. Strategic Petroleum Reserve releases could offset shortfalls temporarily. Increased output from Saudi Arabia, UAE, or U.S. shale might cap the upside. Global demand is relatively soft right now, which might temper the full impact. So in short term, a war with Iran would spike oil prices, cause market volatility, and hit global supply chains and shipping costs. Now, don't knock Donald Trump completely, because pulling out of the Iran deal means that oil prices is the only thing that could be affected by the Iran war. All right, that's the show, folks. Thanks for listening to Qualitative Listening.